All right, so we're here for March 2018 Greater Charlotte market update. Once a month, I like to jump on here and just give all of you, our friends and family, just a quick update on the real estate market here in Charlotte, North Carolina, covering Greater Charlotte. A lot of what I focus on today is big picture, what's happening across the country as it goes with real estate and all of that. Really, it's important for us to kind of monitor what's going on around the country. And then if you ever have a question about your home, specifically your subdivision, you want a free home equity evaluation, please be sure to reach out to us. You could just send us an email, info@hprea.com, or you can visit highperformancerealestate.com. So, and I've got some good stuff for you today. So let me share some, just some quick talking points here. And if you're considering purchasing a home, make sure you reach out to us as far as we've got a buyer's guide that we can send over to you. And we also have a seller's guide. So again, just send us an email, info@hprea.com, and we'll get those out to you. So let's quickly go through home prices. And I want to go cross country here. Anywhere from, western part of the country is approaching 9% year over year change in price. And in the South Atlantic, we're about 6.5%. This is just year over year as reported by FHFA. And if you look at on a state by state basis, we're pretty much 6.7% in North Carolina, 6.5% in South Carolina. And so I want to go here. So this is percentage increase by state again. So this is 5.5%. So the United States overall is 6.6%. North Carolina, South Carolina, we're in the mid fives. One thing I want to go through though is the appreciation over the last 5 years. So there's reports about slowing appreciation rates, and a lot of the news can be a little or not even misleading, but confusing here. So over the last 5 years, the United States has gone up 37% in terms of value. So this is looking back to 2013, so just past as the market started to recover. So 5-year increase overall across the U.S. around 37%. North Carolina, we're at about 25%. South Carolina at 29%. And here's where the reports can be confusing because forecasted growth is going to be less than we've actually seen over the last 3 or 4 years. So it's not that home prices aren't going to increase as per the forecast. They will increase. It's just going to be at a slower rate than we've seen historically. Frank Nothaft from CoreLogic, he's their chief economist, says the number of homes for sale has remained very low. We are desperate for inventory. So if you're considering a move, a trade, you definitely have to reach out to us. We'll give you a free home equity evaluation because we're desperate for inventory. We can't find homes for our buyers. We've got like 50,000 buyers in our database, and we're desperately seeking inventory. So, so the number of homes for sale has remained very low. Job growth lowered the unemployment rate to 4.1% by year's end, the lowest level in 17 years. Rising income and consumer confidence has increased the number of prospective home buyers. The net result of rising demand and limited for sale inventory is a continued appreciation in home prices. So there's no real fear that home prices aren't going to go up. It's just a question of if they're going to continue to go up to that 5.5 to 6.5% range that we've seen, or if they're going to slow down a little bit. Here you can see the monthly year-over-year price increases according to Case-Shiller, which is a 20-city composite of the real estate market. So this is a nationwide panel in terms of expectations for home price increases or where home prices will go. So looking back historically, so pre-bubble, so the bubble is said to have started in sort of January 2000, tech bubble, stock market, all the craziness that happened from January 2000 to April 2007, which is the technical end of as far as the country goes, what was considered the date range of the bubble. If you look for the 12-year period before the bubble, 87 through 99, there was a 3.6% increase, average annual increase over that time. During the bubble years, it was 7.1%. Then we had a period of time for about 4.5 years where the average annual decrease was 5.5%. And now we're recovering from that. So January 2012 is when we sort of lifted out of that, out of the bust. And now through this data covers through the end of 2017, and we're at about a 5.3% increase. So and I'm going to show something here which is pretty interesting here in a second. So like I said, it's not so much that we're calling for for there not to be an increase in prices. We are, and that, by we, it's not me. This is a home price expectation survey. This panelist of economists and folks across the country. They're calling for it to slow. So 2018, they're calling for 5% overall, then to 4% in 2019, then an average of 3%. Beyond, even if you break out the bulls, those that are optimistic about the real estate market from the bears, you're still looking at an 8.3% overall increase in house prices to 2022, on average 18%. So those that are a little bit pessimistic still are forecasting an 8% growth. The optimists are 27%, on average 18% increase in your equity of your home, just overall, if you look at those numbers. So Darren Blomquist says it is the most profitable time to sell a home in more than 10 years, yet homeowners are staying put longer than we've ever seen. Zillow says if the housing bubble and bust had not happened and home values had instead appreciated at a steady pace, the median home value would be higher than its current value. So let me explain that. So this is going back to 2000. So this is when the bubble years began. You can see the bubble goes straight through 2006, 2007. It's a little bit of a downtick. And then you can see this sort of works its way out until 2012. And then we've been seeing a steady increase from there. So if you normalize this at 2000 prices, tag that as the baseline, and you were to put a normal level of appreciation on an annual basis, you would see 2017, the blue line here. So this is a straight line appreciation. The blue line is actually ahead of where we would be without the boom and the bust. So the boom happened, the bust happened, and we're behind where we should have been or could have been if it was just a normal level of appreciation. Hope that makes sense for you. If it doesn't, reach out to us, info@hpra.com. So our pre-crisis peak, you take home prices back to before the bust, and you look at how much homes have increased since that time. So for North Carolina, it was August 2007. We still have seen a 10% increase dating back all the way almost 11 years now. So just think about that. We still have, so it's only a 10% increase when you take out the boom and you sort of normalize it against the bust. So it's not crazy when you think about it that way. So mortgage rates is definitely something to consider. We're in definitely an increasing mortgage rate environment. So it's something to really keep your eye on, especially home seller or home buyer. We need to be smart on mortgage rates. They are forecasted to increase pretty much across the board. And what that means, buyers' purchasing power goes down as mortgage rates increase. So you can see this graph here. If mortgage rates were to go from 3.75 to 4% to 4.25% to 4.5 to 4.75, you could see these green boxes here, the 1389, the 1396, the 1402, the 1406, the 1408. Basically, that's saying that as rates increase, the 300,000 of buying power goes down to 292.5 to 285 to 277.5 to 270, keeping everything else the same except for interest rates. So just you have to sort of consider that interest rates clearly have an impact on what a buyer could afford, because it's all about payment. Very few buyers are coming to the market with all cash. Another thing to consider, people want to sort of make the assumption that increasing interest rates will lead, because it's less buyer purchasing power, it will lead to a drop in prices, and the historic data does not show that. So generally, when we're in an increasing interest rate environment, that means times are good, and that's one of the methods that the Fed uses to temper good times so it doesn't run out of control. So you can see the historical periods where interest rates have gone up, 93, 94, in 96, 95, 2000, 2003, 2004, 2006, 2012, 13. increased rates increase the amounts here: 238, 12, 181, 106, 118, 111. And you can see over that same period of time, the percent increases in homes during that period of time. So you can see when right before the boom years, 95 to 2000, interest rates went up and prices went up 13%. So sometimes double-digit growth in home prices as interest rates were increasing. So it doesn't really pan out the way that some like to say that it would in terms of the link between prices and interest rates. So Freddie Mac says, in the current housing market, the driving force behind the increase in prices is a low supply of both new and existing homes, combined with historically low rates. As mortgage rates increase, the demand for home purchases will likely remain strong relative to the supply and continue to put upward pressure on home prices. And so going back to that, same sort of analysis here. First American says, historically, a 30-year fixed rate mortgage at 5% is still a very low rate. I remember I wasn't even in the crazy times where interest rates were bizarro world. I got an 8.5%, 9% rate on the first investment property I bought. And then I refinanced it, I remember, at 7%, and then it sort of went down from there. And that was like 1999 or so. So 5% is still crazy low. In fact, the mortgage rate has been greater than 5% in 38 of the last 46 years. So it's unlikely that large numbers of home buyers will be dissuaded by a modest increase in mortgage rates. There are a variety of reasons why people buy homes that are completely independent of mortgage rates. So not everyone's sort of looking at mortgage rates and trying to time the market. There's life changes that have people in the market or not in the market. A gradual rise in mortgage rates won't change that. There are folks that they call it the interest rate lock. You're sort of chained to your home because of the rate you have on your property. So, but higher mortgage rates have secondary effects as well. Consider homeowners who bought their homes in the past few years or who've enjoyed a refinance at rates when they hovered closer to 3%. Unless a move is absolutely necessary, those owners are likely to balk at having to sell their home and then borrow at higher rates for a new one. Interest rate lock matters. And so that's something that we definitely want to look at. Zandy cautioned that he doesn't think rate lock kicks in until rates are well over 5%, however. So they're not going to, folks that have a 3.75% interest rate, they're not going to balk until rates get over 5%. He calculates that a 1% point increase in rates will increase the tenure of a typical American homeowners by just over 6 months. Also not helpful in a market starved for activities. In terms of appraisals, we had an issue about a year ago with appraisals. They were coming in lower than the contract price, and now they've sort of leveled out. You can see the relative delta here is kind of going away. In terms of the luxury market, a quick quote here is the biggest difference between December 2017, January 2018 is the increase in number of single-family luxury homes coming onto the market. The most consistent trend transpiring currently is the transition in the luxury homes from a balanced market into a buyer's market. So we are definitely a buyer's market position in the luxury market, where you could say average days on market is actually getting close to almost double what it was just about 10 months ago. So in terms of home sale data, we like to give you some perspective on what's going on in the country here. Days on market, we're actually in about 21 to 25 days on market here in Greater Charlotte. You can see in North Carolina, South Carolina, we're pretty low in terms of days on market. And there's not a whole lot of distressed sales. That's short sales or foreclosures. They've gone from 35% of activity in our market back in January 2012 to 5%. We even have less than that. So in terms of inventory and traffic, seller traffic, we are in a stable position in North Carolina in terms of the amount of homes that are on the market. We're still in need of inventory. In terms of months of inventory, you can see peak months back in 2011 and 2012, and we're again in a seller's market. In terms of foot traffic, this is a big deal. This is an indicator of the future sales. So we're in a strong position both in North and South Carolina. You can see the foot traffic here. January 2018 is the latest data point we have, and it's trending ahead of January 2017 and January 2016. And so we've got, we're strongest foot traffic we've seen on the buyer side. Last 12 months, you can see, and then 2018 is coming out strong. We talked about interest rates and the increase there. Pretty much across the board, you can see Q1 2018 through Q4, on average going from 4.28 to 4.68, so about a 0.4% increase in mortgage rates. We talked about that. Let me quickly talk about FICO score. This is your credit score. A lot of people think that if I don't have an 800 credit, I can't buy a home. You can see that 53.5% of transactions happened in the 600 to 749 credit score range. So lenders are still getting loans done in the 600 to 700 range. You can see about 29-30% of loans, 3 out of every 10 loans are happening under 700 credit score. So that is a quick update. Again, if you want the spring buyer's guide, just send an email to info@hprea. No obligation whatsoever. Same thing with our seller's guide if you're thinking of selling your property. And if you want to get an idea of what your home is worth, go to highperformancerealestate.com. There's a simple form on that website that you can fill out to get a free home equity evaluation if you're thinking of selling your home. And I want to give you so I want to stop to share here. And I want to share a different screen. I want to show you the data that we have access to. So if you have something specific that, all right, let me share my screen up in here. So just some local dynamics. So a lot of the stuff I went through was, it's really helpful to understand what's going on around the country, but what matters is what's happening here in Charlotte. So this is looking back to when this data was first available. So this is January 2004. And it's not how we price homes. It's just to look at a general dynamic of our market. This is just dollar per square foot of home sale price. So you could see last peak was as high as $102 per square foot. Our low went down to 83 and we're back up at 115. So relative to the size of the homes that we're selling today, and it's not a perfect measurement because there's a mix of homes in there, it's well ahead of where we were, 115 bucks per square foot. And I could do specific areas, and this is a 7-county MLS. So it's not intended to say your home is worth 115 bucks a square foot. It could be, most homes are more than that if you're in Charlotte proper or Union County, or some of the surrounding areas in Charlotte. In terms of sales price, you can see this has a lot to do with mix of properties as well. We're at an average sales price in February at $220,000, and our peak before was 170, went down to 150. Our average price point, we serve multiple segments of the market. So we're, 300 to 500 is not necessarily a trade up buyer, but a lot of our listing inventory, that price point is moving really, really well. Trade up is typically 5 to 750 or 750 to $1 million. And like we said, there's some good inventory available in the luxury market as well. You can see sales price there. You can see days on market. So you see days on market. We were at 94, 95 days on market at the peak. We were down to 39. And now we're at about 19 days on market in our MLS. So we're moving homes really, really quickly. So it's definitely a seller's market. So that is all I've got for you. If you have any questions whatsoever, please reach out to us. You can either email us, info@hprea.com, or you can go to highperformancerealestate.com and you can get a free home equity evaluation. It's no obligation whatsoever. If you want that buyer guide or the seller guide, email us as well, and we'll send that out to you right away. Any questions? Like I said, send them on over, and we'll see you next month for another market update. We'll talk to you later. Bye-bye.